Jay Gragnani is joining us, Vice President and Head of Research and Client Engagement at Nasdaq Dorsey Wright. It's great to see you.
Great to be here. Thanks for having me.
On a day where we're selling off over 700 points. I mean, this morning you saw the futures, you knew it was coming. The obvious is the obvious, that China's not supporting its currency. There's concerns about tariffs. All of these things. We have a market that may have been overbought. You know what I mean? So it's all lining up for a day of selling. But I'd like to play the devil's advocate and say, listen, there could be some people who are saying, listen, I love that the Fed is ready to cut again. Tariffs is a good way to really stick it to China and have some tough talk.
Sure.
And our economy is not that bad. So maybe today is too much of a knee-jerk reaction. What would you say to somebody who said that?
Well, it certainly could be. You look at the market today and you look just a week ago and 10 days ago, and the market's sitting at new all-time highs.
Right.
Fed comes out and cuts rates 1/4 point, which was the expectation. And it's interesting when you go and you look at that and you look at the periods historically where the Fed has cut interest rates when the market has been at or very close to all-time highs and see what the market has done after that. And it's pretty interesting where if you look over the past 30 years, going back to 1990, every time the Fed cut interest rates while we were at new highs, there was a positive return on average in aggregate across all those times.
I wonder over what period
one difference,
of time that was.
1990 forward, so basically
right,
the past
no, but I'm
30
saying
years.
At what point do you actually reap the benefits? Is like, do you think that you said that after they cut
Yep.
during a market high, that then you got more, beneficial and stocks move higher. But I wonder if that was within 3 months, 6 months, or over the next year.
The biggest benefit, we looked 1, 3, 6, 9, and 12.
Oh.
And what you saw was that the biggest was over the 12-month time period.
Okay, so in a month,
the 1 month
year
still
from
being
the
positive.
cut, we should be higher. That's what you're saying.
If history is any guide.
Right.
And if you look at it, the one time it wasn't was 2007. You look September, October 2007, right before heading into the global financial crisis was the time that it wasn't.
I mean, the other thing that we're battling, as you noted, was some seasonality and a somewhat overbought market, right? I mean, those are two negatives for the market.
You mentioned it earlier. I mean, we were coming into the month of August being on the overbought side of the ledger, and between last week and today, we're going to basically move back into the oversold side of the ledger, not only for the broad indexes, but for a lot of individual names as well. And you look at August is the second half of the seasonally weak period in the market. August is historically a very weak month for the market. Out of all 12 months, it's the 10th out of those 12 in terms of performance, averaging net losses for the month of August. September historically is not a great month for the market. In October, you tend to get some volatility.
Right.
So if you just look at the seasonality side of things, it's certainly heading into a weak time period. When you look at across the board, though, and you think about what happened when the market hit new highs back in July, just recently, not too long ago, it hit new highs with less participation in the market, less breadth in the market, and that's something.
And less conviction.
And that's something we're going to certainly look at. Yeah.
I mean, that's what are some of the other things I saw you were looking at? Relative strength and bullish percents, and tech, utilities, real estate. What were some of your thoughts on some of these bullet points? Yeah,
so the bullish percent is kind of what I was getting at. If you're not familiar with the bullish percent, it's a breadth participation indicator that we track that simply looks at the number of stocks that are on point and figure buy signals. So if you look at all S&P 500 stocks, if 50% were on buy signals, 50% are on sell signals, that indicator's right at 50%. What we are seeing now is a reversal down in that indicator last week, which made a lower top. And so while the market indexes hit new highs, this index was making a new low.
So do you use that? I mean, I know what it's saying. But could you and would you use that as somewhat of a contrarian indicator to say, hey, listen, you know what? We're selling off over 700 points. In a year from now, we're probably going to be higher. Would you buy some dips here?
I would look for some signs of evidence that demand is re-entering the market. So I would look, if we're talking about the bullish percent, I would watch for that chart to reverse back up before stepping back into it.
And that would be a buy.
And that would be certainly one way to buy. I would look towards those leadership areas of the market. Technology still from a long-term leadership position is our #1 ranked sector. And so as we go back in, as we see some of those indicators turn back around after selling off of the past couple weeks. A lot of technology names look interesting, as do utilities. Utilities as a sector, certainly traditionally seen as a safe haven area, but this year has been a good sector, has provided decent stability, especially during the last pullback that we got in the month of May, April and May time period, seeing some stability at least right now. So we'll continue to see, but utilities is certainly still an area that we're watching too.
Perfect. Jay Gragnani, Vice President and Head of Research and Client Engagement at Nasdaq, Dorsey, Wright. Great to see you.
Great to be here. Thank you.
Thank you so much. Let's see what kind of day it is next time you come in, and we'll circle back.